Hello and welcome to The Wire Live. I'm Sharmita Kar. Union Finance Minister Nirmala Sitharaman has tabled the economic survey in Parliament today, and the government projects the Indian economy to grow at a rate of 6.8 to 7.2 percent in the coming financial year. So to discuss the economic survey today, I'm joined by the YS founding editor, MK Venu. Hi, Venu.
Hi, hi.
So, you know, s- to begin with, I want you to help us understand a little bit about what the significance of the economic survey is. Why is it important that people should look into it?
So, Sharmita, the economic survey essentially is a document which is year after year presented just a few days before the budget, and it talks about essentially the previous financial year. It talks about the state of the economy, economic performance, achievements, etc., economic indicators for the previous year. In this case, it will be 25, 26. But more importantly, it also, since it's a comprehensive document with full analysis by the chief economic advisor in the finance ministry, in this case, Anant Nageswaran. In the past, we've had people like Arvind Subramaniam, and before that, Dr. Shankaracharya, etc. We've had very, a very important economists, very well-known economists as chief economic advisors. So, so they write this survey, and they also give an outlook for the coming year, which is what people look out for. Like we as journalists, global investors, other analysts, they look out for what the survey says about the coming year. So, and in that context, this survey is pretty unique. I'll come to that anyway.
So coming to that, this survey, although it projects a GDP growth as it does year after year. What's interesting in this year's survey is that it admits to the global uncertainty, and it sort of admits that that will impact the Indian economy
Yeah.
in some ways. So,
Yeah.
what are your key takeaways from the economic survey this year?
Yeah. So that is one respect in which that's one aspect of the survey. Forward-looking analysis talks about a lot about global uncertainties. Talks about the geopolitical churn that's going on in the world following Trump tariffs and etc. And China's rise, tension between different blocks, as it were, different, the BRICS versus the West, even the fracture that we see within NATO, past alliances coming apart. For instance, if you go back to the Canadian Prime Minister's speech, it shows that even the U.S. Long-standing U.S. allies have begun to distrust the U.S. Given the way the unilateral manner in which Trump is behaving, and the overall impact that it has had or it is having on various economies. The survey devotes a lot of time to that, and this is I've not seen this happen, at least in the last decade or so. So much emphasis on global headwinds, which may impact the Indian economy, which may impact particularly the Indian currency, rupee. In fact, what I find very interesting is the chief economic advisor kind of admits in the survey that even though India has a relatively decent growth rate compared to other major economies, and a relatively moderate low inflation, and other macro indicators, uh, he says in spite of all that, there is a serious there are concerns about the currency, and there are concerns about foreign investment flows, which have dried up virtually. Last 2 years, the FII flows, foreign portfolio flows, that the flows that come to the stock market have been net negative. And survey gives a full kind of account of how much net outflow of foreign portfolio investments happened in 25, and it says even in January itself, about $4 billion have so far net outflow has happened on the foreign portfolios account. Foreigners are selling stocks and actually and taking money out, and foreign direct investment also has been net. FDI has been negative in 24, 20, in 25, 20, 26. It's slightly positive, but still tending towards zero. Last 2-3 months have been negative, but 24, 25 was negative. So we are seeing, consistently successive years of negative foreign portfolio investment, which is called FIIs, and foreign direct investment, which are like companies that invest in India. And the chief economic advisor clearly says that this is unusual, and considering that India's macroeconomic fundamentals are reasonably good, this is unusual. The Indian currencies, the term he uses is punching way below its weight, and we are already seeing the rupee, touching 92, and it's
Yeah.
continuing under pressure, and it continues to be under pressure because foreign investment flows are negative, and there is assessment that in the coming months the rupee will continue to remain under pressure because foreign investment flows are not coming back so soon, particularly because of the global trade and economic churn. So the way global economy, the way the global trade war is taking place, realignments among countries is taking place. The way India is signing free trade agreements with countries just to counter the negatives that we are experiencing vis-a-vis US with US. So it's a year of churn generally. So that actually the economic survey reflects that, and we don't know how really things will pan out. And it particularly talks about, for the first time I've noticed, it talks about geopolitical scenarios. I mean, I've never
To
seen
a
in the
great
past
extent.
that we're talking about geopolitical scenarios where there are three scenarios they're building, managed disorder, multipolar breakdown, and then the last one is a big geopolitical shock. The shock is about what happened in the US. For instance, this year the US is entirely dependent on AI to drive its economy and its financial system. If AI fails, if the AI story in the US fails, you can be sure that the US financial markets, there will be a meltdown, and that meltdown will then have ripple effects across the world, and India is not immune from that. So these are some of the things that we need to actually watch out for in 2026.
So it's interesting. So the US tariffs, trade tariffs, have impacted a lot of countries. I mean, they were imposed around last year, and India particularly has faced a setback because of that, because of the steep 50% tariffs that were imposed. What do you think is going to be the impact of that in the coming year?
So Sharmita, US was India's biggest trading partner. Now, uh, it's very clear that we had about $80 billion of exports to US, and of this, uh, at least $40 to $45 billion of exports. The sectors that export $40 to $45 billion have been badly affected, which includes, we all know, very labor-intensive industries like, like leather, garments, textiles, gems and jewelries. These are highly employment-intensive, and even the opposition, Rahul Gandhi, has raised questions as to what is happening to textile workers. How long will they have to suffer? So the real, uh, impact in terms of small and medium enterprises in these sectors, export-oriented. Uh, so far, the tariffs kicked in sometime in like September, right? The full 50%, August, September. So for the first few months, things seemed all right because firms were kind of adjusting. Firms were trying to the export, the seller of goods from here, India, was trying to absorb the loss of margin because of the tariffs there. To some extent, the buyer in the US were also trying to absorb part of the the tariff, instead of passing it entirely onto the consumer. But this cannot continue forever. Now the impact of the shock will be felt actually this year now. You will see in the next few months a large number of medium enterprises in the leather, garments, textiles closing down, and that's where the real pain will come. And I guess there are already some indications that the budget will be little more liberal in terms of fiscal uh, uh, allocations, because they realize that the budget will have to allocate some money to deal with these shocks, which will be felt by all these sectors because of the US tariffs, right? So the other thing is the Indian exports are kind of holding up, barely holding up at the moment, but we'll see that merchandise exports will decline in the coming months. At least to the US, it was kind of until November, December, it was holding up, but now there is assessment is that it'll go down. The trade deficit now has been like growing, and because of exports going down, imports have not gone down to that extent. Especially gold imports have really have gone up. So the trade deficit is expanding, and so is although the current account deficit is reasonably under control at about 1.5-2%. But the real worry is, which the economic survey points out, normally at 1.5 to 2% current account deficit in the past will not cause any worry, because 2% of GDP, which is the current account deficit, would be made up through foreign capital inflows. This time, the economic survey clearly says that it's a matter of worry that the deficit, the trade deficit, will not get compensated by the net foreign capital inflows. In fact, it specifically says that in spite of India getting $130 to $135 billion of remittances, net remittances into the country through Indian workers, working abroad, and in spite of India earning net inflows on services account, India has done well on services. A lot of the Indians who provide services, either sitting here or when they go out, like our IT professionals, they provide services to foreign companies. So you get a net inflow from there. So even after adding the remittances and the surplus that you get on account of services, it is not making up for the loss for the expanding trade deficit and current account deficit. That is a matter of real concern, and the survey says that is what is resulting in the continuing pressure on the rupee. So we don't know whether where will the rupee go and settle down? Whether it's currently close to 92, whether at the end of the year it will be 95, 96. It all depends on the net foreign capital inflows. So that is the real worry. And the other problem is, which of course the survey doesn't say, but it implies that because of global churn, what happens is all the big corporations, after all, who invests money? It's big companies, right? Big companies always wait for policy clarity coming from the US, coming from here, coming from Europe, coming from, so they won't invest unless there's a final clarity on what policies they are dealing with, what tariffs they are dealing with, what non-tariff barriers they are dealing with. So that's a big real, in my view, that is the biggest concern, that global businesses will not invest unless there is clarity on trade policies around the world, clarity on how the trade wars will pan out. Will there be peace? Will there be some settlement among countries? So that's a big issue.
And these are private investments that we're talking about, private companies.
Yeah, I'm talking about private companies. You see, all foreign investment, all private companies, no?
Yeah.
In fact, forget about foreign companies investing. Even the domestic companies are not investing, because they also want clarity on, the Ambanis and the Birlas and the Tatas and the others. Before they invest, for instance, before Tata Steel, for instance, invest in, let's say, doubling their capacity over the next 5 years in steel, they would want to know where all they can export their steel. They would want to know how the India-EU free trade agreement pans out, because India-EU free trade agreement would give Indian steel, Indian aluminium, Indian commodities access to European market. But then even that FTA, mind you, although it has been agreed upon, but actually it will kick in only next year, January, Feb. The actual implementation will have to wait a year, because the FTA has to get cleared in the European Parliament. It has to go through various other legal hurdles at the European Parliament, European Commission level. So that is, although it may be good for India to have access to the European market, but it's not happening before, say, January, February 2027. So one full year we have to wait. And this 1 year is very critical. And it's during this 1 year that all this geopolitical churn is going on, So, So what will happen to the Indian rupee in the next 6 months? What will happen to various other, indicators as a result of that? These are big question marks. And the economic survey, it really, I'm happy that it concedes some of these things, and it hints at some other problems, both at the global level and at the domestic level. Yeah.
So the one thing that I noticed, however, was that it mainly focuses on the external factors more than the domestic elements affecting the economy. And so one of the major attractions in 2025, which was announced around Diwali, was the GST rate cuts.
Yeah.
So, the government has also called it an overhaul. It was a major attraction that was supposed to attract consumers and benefit the economy. But do you think that it has had any impact, any positive impact, and will it have any further impact, or do you think there will be any more announcements around it?
Actually, yeah, why did the government do that big GST reform? They reduced GST rates. Everything flows from what was happening with the Indo-US trade deal, right? There was so much pressure on India to do internal reforms, even as optics, as a counter to what was happening from the what was the external headwinds that were hitting us. So India did GST reforms. Now we cut GST tax rates across the board. Then there was a feeling that now there was consumption would pick up, and indeed there was some little pickup in consumption during the the festival season, right? October, November, etc. But after that, all the analysts in Mumbai and economists around the country, they have concluded that the GST bump up happened for a couple of months, and then we are back to our consumption is again it's tepid. It's not. There is no meaningful across the board demand growth happening, right? Consumption growth. So similarly, so that's about GST. The other thing is there is also this concern about inflation. Now, the economic survey proudly boasts that India's inflation rate is now very low. It was like 1.6%, 1.7%, 25, 26. But nobody believes that that inflation rate, right? What people experience is I mean, we all know it's very different. And India's nominal GDP growth rate, again for the previous year, economic survey puts the nominal growth rate at 7.6%, 7.7%, whereas the real GDP growth is 7.4. So there is very little gap between nominal and real. So that has led to conclusion among economists that probably the real GDP growth rate is exaggerated by maybe 2 or 3 percentage points, which economists like Professor Arun Kumar and Arvind Subramaniam, former chief economic advisor, they all have now come to the conclusion that Arun Kumar has stated this in his writings in the Wire. He's also in a conversation with me. He has explained why the real GDP growth rate in India might be at least 3 percentage points lower than what is officially claimed. So that's exactly what that Arvind Subramaniam, Professor Subramaniam has also said. And that is what the IMF also a couple of months ago in its assessment has put out, that IMF has said that there could be sizable discrepancies in the way India's GDP is calculated. So what all this has done is it has also made global investors a bit doubtful about the real growth rate. Although people admit that India is relatively our growth rate is relatively better than other major economies, but people are not entirely convinced that it is growing at the rate that is officially claimed. Yeah. So these are some of the things which, economics is also about perception, right? So that could be one reason why foreign investors are still waiting in the wings, And often what happens, Sharmita, is that foreign investors, they always wait for the domestic companies to invest first, because that's what they take the lead from domestic companies. So they follow the domestic companies. So if the domestic companies themselves have not really increased meaningfully their investments in the economy, barring some of the big ones, Adani's, Tata's, maybe the big 4 or 5 have been sort of investing in infrastructure, etc. But that constitutes probably less than, these companies, their turnovers would constitute less than 5-6% of the economy, GDP. Yeah. The larger universe of medium size companies, they are not investing.
Yeah. So going by the economic survey and the concerns that it points out, and everything that it states, what do you expect from the union budget based on that? Is there any expectation?
I would suggest that the union budget would be like a holding document. See, what the government does with its budgetary resources, it won't sort of make any substantive difference to all the other factors, as I said, the global factors that are affecting various economies, right? So budget can at best signal. Budget can say, okay, it can signal that we are here to, if the economies, if there are shocks coming from the global geopolitical churn, budget can say we are here to build build a cushion. So they may say, okay, we have enough, say we will provide enough in terms of a fiscal headroom to deal with any possible shock. Budget can possibly do something to ensure that foreign investors they are attracted to bring uh, investments into the country so that the rupee stabilizes. But the thing about the budget, Sharmita, is, I mean, I was thinking about this thing. Uh, what is How do you make a budget in these circumstances when there is so much global churn, trade wars going on, alliances breaking down, new alliances being built around the world, economic alliances, geopolitical alliances. So, if I were to make the budget, what would I assume the rupee to be? See, budget has to assume a certain value of the rupee, like over the year. Would I assume 91, 92? Would I assume 95 rupees to a dollar? Would I assume 100 to a dollar? You don't know. What would I assume the oil prices to be? Because all this geopolitical churn can also make oil prices go up and down. What do I assume the GDP, nominal GDP to be? What do I assume the inflation rate to be? Right. So, budget has to make a lot of. What is a budget? Budget is a kind of a set of assumptions based on which you say, okay, we feel that the economy is going in this direction, and and it's the government spending and how the government can, let's say, government can push the economy in a certain direction with its own expenditure strategy and its own revenue strategy. That's what the budget is all about. There is a lot of worry about our revenues also. Like the previous 25-26 revenue growth is way below the projected, budgeted. The tax revenue growth is lower than what is budgeted. So one doesn't know, because your revenue projection is based on your nominal GDP growth. So when the nominal GDP growth has come down so much, it is affecting the revenue projections also. So net, what I'm saying is full of uncertainties. So the budget can at best do a holding operation based on some assumptions. Now, whether those assumptions come true or not is another question, actually.
Right. Okay. Thank you so much, Venu, for joining the Wire Live. And stay tuned for more such interactions on the budget, which is coming up on February 1. And
Thank you.
thank you for joining.
Thank you.